While headlines are dominated by elections, wars, and the daily noise of markets moving a few tenths of a percent, something far more structural has been unfolding in the background. Over the past 12 to 18 months, roughly $6 trillion in capital across sovereign bonds, bank balance sheets, shadow banking vehicles, and institutional portfolios has begun migrating away from the assumptions that defined the post-2008 era. The core event can be stated in one sentence. The world is shifting from an era of unlimited liquidity to one where capital has a real persistent cost again, and the system is not built for that transition. Most people are missing this because nothing has crashed in the cinematic way 2008 did. There is no Lehman moment, no overnight freeze of ATMs, no single villain. Equity indexes still flirt with highs. Employment numbers remain superficially resilient. The illusion is continuity. But underneath, the machinery has changed. For over a decade after 2008, the global financial system operated under an implicit guarantee. When stress appeared, central banks would expand their balance sheets. Between 2009 and 2021, the Federal Reserve, ECB, BOJ, and PBOC collectively added over $25 trillion in assets. The U.S. policy rate averaged 0.6% from 2009 to 2021. Capital was not scarce. It was abundant, almost frictionless. That regime is over. Since 2022, policy rates in the U.S. have risen from 0.25% to over 5%. Quantitative easing has reversed into quantitative tightening. The Fed alone has allowed more than $1.2 trillion in assets to roll off its balance sheet. European and Japanese policy is following, slower, but in the same direction. Meanwhile, governments are issuing record debt to fund deficits. U.S. Treasury issuance alone exceeded $2.3 trillion in 2024. Here is the forcing mechanism most people miss. When risk-free yields move from near zero to 4 to 6%, every asset in the system must reprice. Not emotionally, mechanically. A pension fund that previously needed a 7% annual return from equities can now get 4.5% from treasuries with no volatility. A bank that once funded at 0.2% now funds at 4 to 5%. A government rolling $1 trillion in debt annually faces interest costs rising from $20 billion to $50-60 billion per year. This is not a cycle, it is a structural reset of capital's price, and that is where the $6 trillion comes in. Across global markets, institutions are quietly reallocating. Out of long-duration growth assets, out of leveraged strategies built on cheap funding, out of sovereign bonds priced for zero-rate worlds into short-term yield, liquidity, and balance sheet safety. The crowd is looking for a crash. The system is executing a migration. What's at stake is not whether stocks dip 10% or rally 12%. What's at stake is whether an economy built on refinancing, leverage, and financial compression can function when capital once again demands a return. This is the part most people miss. 2008 was a liquidity collapse that was met with infinite liquidity. Today's environment is a liquidity withdrawal that is intentional. Now here's where it breaks. Markets are still pricing the future as if policy will always revert, as if every stress will be met with rescue, as if capital will again become free. But balance sheets, public and private, are already absorbing a world where that assumption no longer holds. This is not about fear. It is about math. Disclaimer: this content is for educational and informational purposes only. It is not financial advice. Markets involve risk, including the potential loss of capital. Nothing here should be interpreted as a recommendation to buy or sell any asset. Always consult qualified financial professionals before making decisions. To understand why this moment is fundamentally different from 2008, you have to stop thinking in headlines and start thinking in balance sheets. In 2008, the system broke because credit vanished. Banks stopped trusting each other. Funding markets froze. The solution was to make capital effectively free. Central banks cut rates to zero and injected liquidity until the pipes worked again. The cost of money collapsed. That single variable, the price of capital, solved everything from bank solvency to equity valuations. Today, the system is breaking for the opposite reason. Capital is no longer free. Every financial structure built over the last 15 years assumed a world where borrowing costs hovered between 0% and 2%. Refinancing was routine. Duration risk was rewarded. Leverage was cheap and stable. Cash was a wasting asset. Those assumptions shaped everything: tech valuations, private equity models, government budgets, housing affordability, and even corporate behavior like buybacks. Now replace that with a world where risk-free rates are 4 to 6%, term premiums are rising, central banks are shrinking balance sheets, governments are issuing record debt, Banks must compete with treasuries for deposits. That single shift forces a mechanical repricing of the entire asset universe. Here's a concrete example. Assume a company expected to generate $10 per share in free cash flow 5 years from now. In a zero-rate world, investors might discount that at 3%, valuing it around $8.63 today. At a 6% discount rate, that same $10 is worth $7.47. That's a 13% drop in present value, without any change in the business. Now scale that across trillions of dollars in assets priced under low-rate assumptions. It gets worse when leverage enters. A private equity fund buying a business at 10x earnings with 70% debt in 2020 might have borrowed at 3%. Annual interest on a $700 million loan, $21 million. Refinance that same loan at 7% and interest becomes $49 million. If the business only generates $60 million in free cash flow, the margin for error collapses. Growth delays become existential threats. Asset sales become mandatory, not optional. This is how a soft rate shift becomes a hard constraint. The mechanism operates through 4 channels. Discount rate repricing. Every future cash flow is worth less today. Growth assets feel it first. Refinancing walls. Trillions in corporate and sovereign debt mature between 2025 and 2028. Each rollover locks in higher costs. Liquidity competition treasuries at 4 to 5% pull capital away from risk assets. Cash now earns. Balance sheet stressed banks must hold more capital against risk while losing deposits to money market funds. The result is not a crash. It is a migration. Institutional capital is moving from long-duration equities, short-duration yield, leveraged strategies, capital-preserving ones, illiquid assets, liquid instruments, growth narratives, balance sheet strength. Estimates from global flow data suggest $5 to $7 trillion has already shifted into money market funds, short-term government paper, and cash equivalents since 2022. That capital is not fearful. It is rational. This is the part most people miss. Markets are not panicking. They are recalibrating to a new price of time. In 2008, the system was broken and money was made free to save it. In this cycle, the system is intact, but the cost of money has changed. And systems built on cheap capital do not unwind politely. They grind, slowly, relentlessly. That grind is the story. Every structural shift in finance eventually reveals who is trapped, not metaphorically, mechanically. When the price of capital changes, someone's model stops working. Someone's balance sheet no longer clears. Someone's timeline becomes impossible. In this cycle, the pressure is building across 5 main groups: governments, banks, leverage funds, corporations with near-term debt, households dependent on refinancing. Each is constrained in a different way, but the pattern is identical. They built for a world where money stayed cheap. That world is gone. Start with governments. The U.S. alone carries over $34 trillion in federal debt. Roughly $9 to $10 trillion of that must be rolled over within the next 3 years. In 2020, refinancing at 1% meant $100 billion in annual interest. At 5%, the same principal costs $500 billion. That is not a political problem. It is arithmetic. Either deficits expand, or spending compresses, or inflation absorbs the burden. There is no fourth option. Every developed economy faces the same dynamic. Japan, Italy, France, the UK, each carries debt loads built under zero-rate assumptions. Now they must refinance in a positive rate world. Next, banks. From 2009 to 2021, banks lived in a universe where deposits paid nearly nothing. In 2023, money market funds began yielding 4 to 5%. Depositors moved. Over $1.5 trillion left bank accounts in the U.S. alone. Banks now face a binary choice: raise deposit rates and compress margins, or lose funding and shrink balance sheets. Either way, credit availability tightens. This feeds directly into leveraged funds. Hedge funds, real estate vehicles, and private equity structures rely on rolling short-term funding against long-term assets. When repo costs move from 1% to 5%, leverage becomes toxic. Strategies that once worked at 6x leverage only survive at 2-3x. The rest must be unwound. That unwind is not ideological, it is contractual. Margin requirements rise, financing terms tighten, prime brokers reduce exposure, positions shrink. Now consider corporations. Between 2025 and 2028, more than $4 trillion in U.S. corporate debt matures. Much of it was issued at 2 to 3%. Refinancing at 6 to 8% doubles interest expense. A firm earning $200 million annually that once paid $40 million in interest now pays $100 million. That compresses CapEx hiring, R&D buybacks. Dividends growth slows not because of sentiment, but because cash flow is consumed by servicing the past. Households are the final pressure point. In 2021, a $400,000 mortgage at 3% cost about $1,786 per month. At 7%, it cost $2,660, nearly $1,000 more. That gap freezes mobility. It locks in labor. It suppresses consumption. It reshapes demand. This is the binary reality. Either rates fall back towards zero, or balance sheets must adjust downward. There is no painless path. The historical parallel often cited is 2008, but the better comparison is the early 1980s. In 1981, U.S. rates exceeded 15%. Debt was purged. Asset prices stagnated for years. The system rebuilt on a new foundation. What's different now is scale. In 1980, U.S. federal debt was under 35% of GDP. Today, it exceeds 120%. Corporate leverage is higher, household exposure is larger, financialization is deeper. This is why recovery will not look like 2009. Then the system was starved of liquidity and flooded. Now it is overextended and being constrained. Either leverage contracts or the price of capital does. One of those must give. To see why this shift is real and not just a narrative, you have to follow the flows, not opinions, not forecasts, actual balance sheet math. Start with sovereign finance. In 2024, the U.S. Treasury issued approximately $2.3 to $2.5 trillion in net new debt. That supply must be absorbed by someone. Banks, pensions, foreign governments, hedge funds, households. At the same time, the Federal Reserve is allowing up to $95 billion per month in treasuries and MBS to roll off its balance sheet, roughly $1.1 trillion annually. That means the market must absorb $3+ trillion per year without the buyer that dominated the last cycle. Now look at who is actually buying. Foreign central banks, once consistent marginal buyers, have slowed or reversed accumulation. Global reserve growth has flattened. Some countries are even selling to defend currencies. Domestic banks are constrained by capital rules. Pensions already hold heavy duration exposure, so the clearing price must rise. That clearing price is yield. Every 100 basis point increase in average Treasury yields adds roughly $350 billion in annual interest expense over time as debt rolls. That is not a projection. It is mechanical. It becomes embedded into fiscal structure. Now extend that logic into the private sector. U.S. non-financial corporate debt stands near $13 trillion. Roughly 30-35% matures within 3 years. If average refinancing rates rise from 3% to 6%, interest expense on just that portion rises by approximately $4 trillion at 3% to $120 billion annually. 4 to over $10 trillion year times 3 percent. 120 to was senior $10 billion annually. 4 trillion 3%, $120 billion annually. That $120 billion is not abstract. It comes from CAPEX payroll growth, inventory investment, shareholder returns. The economy does not lose money. It reallocates it toward debt service. Now consider households. Mortgage debt in the U.S. exceeds $12 trillion. Most is locked at low rates, but new issuance defines marginal demand. Housing turnover has dropped to multi-decade lows. Existing home sales fell below 4 million annualized versus over 6.5 million in 2021. That collapse is not sentiment, it is arithmetic. Monthly payment shock suppresses mobility. Mobility suppresses labor matching. Labor rigidity reduces productivity growth. Here is where the $6 trillion shift becomes visible. Since 2022, U.S. money market fund assets rose from $4.5 trillion to over $6.2 trillion short-term Treasury bill demand, surged bank deposit bases shrank by over $1.5 trillion, duration-heavy bond funds saw persistent outflows. Equity inflows became episodic and momentum-driven, not structural, that is, capital choosing yield over narrative. Now construct 3 simple scenarios. Scenario A, soft adjustment. Policy rates stabilize around 3.54%, Treasury issuance remains elevated. Growth slows modestly. Corporate margins compress by 2 to 4%. Capital remains cautious. Equity multiples drift lower over time. Volatility rises structurally. Scenario B, stress compression rates stay above 5%. Credit spreads widen by 152 to 250 BPS. Refinancing failures rise. Defaults climb from Model 3% to 6 to 8%. This forces asset sales. Liquidity thins. Correlations rise. Balance sheets shrink. Scenario C, policy reversal, growth collapses. Central banks cut aggressively. Balance sheets expand again. Real yields fall back toward 1 to 2%. Stability returns, but only after contraction. In every scenario, the common element is this: the system must reconcile assets priced for free money with a world where money is no longer free. That reconciliation is not emotional, it is structural. This is why normal expectations fail here. People expect a replay of 2009, a crash followed by rescue and reflation. But this cycle is not about broken plumbing. It is about a repricing of time. And time, once repriced, does not revert easily. When structural shifts move through financial systems, they do not travel in straight lines. They propagate through feedback loops. They surface as irrational moves. They break correlations that investors rely on. This is what makes the current environment confusing. In 2009, 2021, markets operated under a simple reflex: bad data, more stimulus, higher asset prices. That reflex is now unstable. In a positive rate, balance sheet constrained world, the transmission looks different. Rising yields tighten financial conditions. Tighter conditions reduce growth. Slower growth pressures earnings. Weaker earnings raise credit risk. Higher risk widens spreads. Wider spreads feed back into funding costs. That loop is self-reinforcing. The first visible symptom is not a crash. It is liquidity asymmetry. You see it in bid-ask spreads widening during routine sessions, ETFs trading at persistent discounts or premiums, Treasury auctions tailing more frequently, overnight funding rates spiking around quarter ends, volatility, clustering without a headline trigger. This is what a system under balance sheet strain looks like. Here's the critical difference from 2008. Then, liquidity vanished because trust collapsed. Now, liquidity thins because carrying risk is expensive. Market makers cannot warehouse inventory when funding costs 5%. Banks cannot intermediate freely when capital is scarce. Hedge funds cannot run high leverage when margin eats returns. So markets reprice through gaps, not smooth curves. A stock misses earnings by 3% and falls 12%. A bond auction clears 20 basis points wide. A commodity future disconnects from spot. A crypto venue trades 2% off global price. Observers call it panic. Structurally, it is rational. This is where feedback loops begin. Volatility rises. Risk parity and volatility targeting funds reduce exposure. Passive flows reverse liquidity, thins further. Price moves grow larger. Margin requirements rise. Forced selling appears. That loop does not require a recession. It only requires capital to become scarce relative to risk. Watch the indicators that reveal this transmission. Credit spreads, investment grade and high yield. Treasury auction bid to cover ratios. Repo rates around quarter-end VIX term structure, ETF premium, discount behavior, cross-asset correlations, stocks versus bonds versus dollar, money market asset growth. In a zero-rate world, volatility was an opportunity. In a positive rate world, volatility is a tax. That changes behavior. Investors shorten duration, they hold cash, they sell optionality, they demand immediate compensation for uncertainty. This compresses forward-looking risk appetite. Markets may still rally, sometimes violently, but those rallies are increasingly flow-driven, not structurally supported. This is why the environment feels unstable without feeling broken. The system is not failing, it is adjusting. And adjustments built on balance sheet math do not care about sentiment. They persist until the structure changes. This shift does not resolve in a single quarter. It unfolds across refinancing cycles, fiscal calendars, and policy constraints. Think in 3 time frames, next 24-72 hours. Markets react to flows, not fundamentals. Watch overnight funding rates, Treasury auction performance, ETF dislocations, volatility spikes without news. These reveal stress in market plumbing. Next 1 to 4 weeks. The system begins to express constraint. Watch credit spreads. Bank lending surveys, corporate issuance volume, money market growth. These show whether capital is expanding or contracting. Next 1 to 2 quarters. The real economy responds. Watch CapEx guidance, hiring trends, earnings margins, default rates. These reveal whether balance sheets are adapting or breaking. Now the scenarios. 1. Base case. Managed contraction. Policy rates drift toward 3.5 to 4%. Growth slows but remains positive. Equity multiples compress 10-20% over time. Credit spreads widen moderately. Confirming indicators, stable but elevated yields. Gradual rise in defaults, persistent money market growth. Sideways equity markets with higher volatility. This is stagnation, not crisis. 2. Stress case. Balance sheet. Event rates remain above 5%. Treasury absorption falters. Credit spreads jump 200 plus BPS. Leveraged players unwind. Confirming indicators, failed or weak auctions. Repo stress. Rapid ETF discounts, forced asset sales. This produces abrupt repricing. 3. Relief case, policy reversal. Growth contracts sharply. Central banks cut aggressively. Balance sheets expand again. Real yields fall below 2%. Confirming indicators, rapid unemployment rise, emergency liquidity programs. Yield curve steepening fiscal expansion. This stabilizes markets, but only after damage. In every scenario, one truth remains. The post-2008 world was defined by abundant capital. The next decade will be defined by priced capital. That changes everything, from valuations to politics to how risk is carried. Markets will still move. Innovations will still occur. Growth will still exist. But the reflex, bad news equals rescue, is no longer guaranteed. This is why recovery will not look like 2009. Then, the system was broken and flooded. Now, it is intact and constrained. The difference is subtle, the consequences are not. Disclaimer. This material is for educational purposes only and does not constitute financial advice. Markets involve risk, including the potential loss of principal. No strategy is guaranteed. Always consult qualified professionals before making financial decisions. If you want ongoing analysis as this structure evolves, subscribe for future updates.